Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by BrightPath Notes. Now, here's your host, Justin Bogard.
Hello, and welcome back. This is now the Be the Bank podcast. We were formerly the Two Wealth Show with my co-host Super E. As you know, if you listened to the last episode on season 3, she is no longer a part of the podcast. She kind of hung her reins up. She had a good run, she said, and she was ready to focus on some things with her business. So now you just got me. So hey, everyone, I'm Justin Bogard, and this episode is brought to you by BrightPath Notes. And so we're going to focus on this podcast now with this rebranding is we're still going to be in the real estate realm, but we're going to talk mainly about storylines, and we're going to talk about and debate and discuss topics in and around real estate. And we're going to focus on as well stories about being the bank and what we do as far as note investors. And I'm going to bring on guests here in future episodes and talk to people about things. And we have a guest for today as well. So let's get right into this episode. Mr. Mick Kuehn, how are you?
I'm doing well, Justin. How are you today?
I'm doing fantastic. Thank you so much for being a part of my new branded podcast and the very first episode of it. This is going to be our season 4.
Well, cool. I'm honored. Thank you.
Yeah, so Mick, I've known you for a few years now. We've both been trained by Eddie Speed.
That's
at
true.
the Note School. And we've become good friends. My family has visited South Carolina many times, and that happens to be where you and your wife, Janet, live.
That's a fact. Yeah. I enjoyed a couple of beachside lunches together. Had a great time.
Yes. What was the name of that place?
Coconut Joe's.
Coconut Joe's. That's right. How can I forget that? It's such a cool name, Coconut Joe's. You're like going to Coconut Joe's right now.
That's right. Good time.
Mick, so let's kind of set the story here for today. Exactly who you are, Mick. So You are a real estate agent. You have a brokerage, and you're also an REO specialist as well.
That's right.
And so you and your wife are both agents?
Yes, we are. We opened our brokerage in 2007 as an independent company. And of course, looking at that time frame, 2008 was just around the corner. And that's when the housing market took a dive. And all of a sudden, we were flooded with REOs, which is real estate owned, which is bank-owned foreclosures. And not only banks are getting in on this, but the Department of Housing and Urban Development, which we all know as HUD, VA, USDA, all these other government-backed loans defaulted, and we had a huge tsunami of properties. And I can't take much of the credit because my wife, Janet, was smart enough to position us into that spot. We started receiving, listings and all kinds of different properties. And we were super, super busy until probably 2018 or so.
Just with the REOs?
Strictly with REOs. Again, Janet was looking forward in time and knowing that this REO wave wouldn't last forever. Yeah. And if there's other REO agents on here, you realize that I'm telling you the truth because right now your inventory is probably at almost zero.
Right.
So she started looking for something in 2012, knowing that we would probably have to pivot and do something different. Mm-hmm. So she ran across Eddie Speed and Note School and saw the tremendous opportunity in notes. And we flew out to Houston and got started in 2012 in notes.
That's awesome. So you've been doing that for about a decade now.
Yes, sir. Almost 10 years.
So you obviously are a very seasoned real estate investor because you're a realtor, you have your own brokerage, you specialize in REO
That's right.
Properties, and you're REO agent, you and your wife. And then also you're a note investor as well. So now you've learned the performing, the non-performing world. So you have a very well-rounded skill set here. I assume you probably flipped some houses and you probably done some rentals as well, right?
That's funny you should say that. We learned that real quick. We fixed and flipped 2 houses and quickly figured out that wasn't for us. And then we thought, hey, you know what? Why would we sell it when we can make the rent? Become the landlords. Well, it didn't take us very long. I think we went through 2 tenants and quickly figured out that we didn't like that either. Neither one of us had the temperament for it.
Yeah.
Not that we're mean people, but we just seem to unfortunately believe people when they're in tough straits.
Yeah, the human side of yourself, right?
Yeah. So unfortunately, when you do that, that doesn't reflect very well on your checkbook.
Right.
So
you may feel good morally, but the business decision isn't always the best decision, right?
Absolutely. Yeah. So we decided we'd do something a little bit more passive, something that made a lot more sense to us. And notes fell right into that spot. And it was one of those aha times when Janet was in her office and she yelled over to my office and said, "You've got to come in here and see this." And it's one of those things when I saw it, I recognized it. We both did and said, "This is what we've been looking for."
Yeah.
Yeah.
It made sense.
Yeah.
Made sense. So thanks for sharing a little bit about your history into the world of real estate investing and kind of who you are and what you guys do today.
Mm-hmm.
One of the things I wanted to talk about, Mick, is that I'm really glad that I know you because I've been having to use this book here. This book is called The Property Preservations for Note Owners. Yep. And this book is written by Mick Kuehn, who is that your twin brother?
No, that's actually me.
Oh, that is you.
That's my given name. My twin brother's name is actually Mike.
Oh, okay.
And that's not a joke.
You have a twin brother named Mike?
I sure do.
This whole time I've known you, and just now I know that you have a twin brother named Mike.
Yep. And the easy way to remember that is Mick and Mike, they look alike.
Mick and Mike, they look alike. That's to be the name of our podcast for this episode right here.
Yeah,
That's
it's
awesome.
been a riot.
Well, I'm glad that I got to read your book, and I'm also not glad that I got to read your book because I had to read it because not only are you my friend, but I had to read it for research purposes because I've had to take back a couple properties this past couple months.
I see.
So this book is just a gold mine of information, and I'm talking to the listener out here. This book is going to tell you everything you need to know from a very detailed checklist of exactly what the process is. Mm-hmm. To having this delinquent note. Once you're dealing with the borrower, you got a couple of options, right? And when you're dealing with this borrower, that home is not probably going to be taken care of as well as you would like. And so if the borrower is willing to leave, hey, great, you got this opportunity. You can take the collateral back. You can go through the process of reselling it, renting it, all the things that we do as real estate investors. Right. If the borrower stays in there, well, then you got a few options as well. But what I really took to light from your book is the detailed checklist of what you have to do when you take back this property when it becomes, an REO. We're talking like you need to check on the utilities. You need to check, you need to search for any tax liens or anything that popped up on this property that you weren't aware of. You need to have preservation companies come out. And like I've had 2 properties in Michigan right now where I've had to winterize pretty quickly. Oh, yeah. And if you don't winterize them quickly, you're going to have a big problem on your hands.
Yeah. And I can honestly tell you when we first got started with this business, we found that out quickly. We had a property in Ohio and we didn't get to it quick enough and it froze up. So that was not like I say, all the time, experience is what you get when you're looking for something else.
Right.
And this is when we gained some experience. So
thanks for providing the experience and a hardback copy for me. Okay. I appreciate that very much.
Oh, my pleasure. My pleasure. It really is. But there's certain items that you really need to pay attention to. A lot of it is common sense. Like you're saying a couple properties in Michigan, mm-hmm. Winterization is definitely going to be a big issue for you.
Especially right now when it's mm-hmm. single digits, right? It's like, you can't get over there today. How do I get you over there today?
That's right. That's usually at a 0.
Right.
But yeah, it's I try to go at it with from a point of somebody new getting into to the note business, okay, and having to take back an REO. I've seen many times with the training platforms that we're in, people will ask a question. Hey, I had to take back a property. What do I do next?
Yep.
Well, there didn't seem to be a whole lot of resource out there for people.
Yeah.
So I decided, as amateur-ish of a writer as I am, I do know the knowledge, and I put it back into a kind of a book form. It's a fairly easy read. It's not an encyclopedia, but it gives you all the steps that you really need to pay attention to.
Yeah, it's great. You made it simple, you made it concise, and you made it kind of short and sweet, if you will. Like you said, it isn't a long novel, but it has all the details that you need to go through to get to an REO.
Right.
And I did have to use them, and there were things in there that I didn't even realize, even being a note investor myself, because you have all this experience with being the REO agent. You know what everything that you've come across that you need to double check and recheck, and it was amazing. Some of the stories that I saw that you wrote in there, I was like, wow, I never thought that could happen, but I'm sure glad that I know about it, because I just wouldn't have thought about it. So thank you for writing that book. And where can we go to purchase this book?
That can be purchased on Amazon. Just go ahead and start punching in the address, the title of the book, and it'll come right up. There's only like one, so it's out there on Amazon, ready for you.
Ladies and gentlemen, Mick has 100% market share of the REO note owner space in a book form.
Come on, I always wanted to corner the market.
That's right. You got it. You're the first one in. One in.
Cool.
All right. Mick, today I wanted to talk about a specific subject that is around real estate that you and I both know pretty well, and that is the affordability factor of homes today and how it relates to seller financing. So for those of you that may not understand what seller financing is, let's pretend like Mick has this property and he wants to sell it to me. And so I say, hey, Mick, I'd like to buy that property from you, but I can't go to the bank and get a loan for it because of this, that, and the other, right? There's a box that I have to fit inside for the bank to qualify me to get a loan from them. And I don't fit that box, but I do have some money to give you, and I can show you that I can make monthly payments, whatever the monthly payment is. Mick says, okay, great, Justin. Yeah, I'll sell you the house and I'll carry back the financing for you on this property. And then Mick becomes a seller financier and he has a seller finance loan. So that is kind of how the seller financing world generally works. It's also called owner financing. People have heard the word land contract and note and mortgage. Those are all things that are seller finance instruments as well. So with the affordability factor, there's been a lot of news about how interest rates are lowering. Real estate prices are appreciating at just, I can't even describe the word, let's say an enormous level.
Yeah.
And so we have a new problem now, which is real estate is so expensive, we're not able to afford it because our pay rate has not gone up.
Sure.
So there's that affordability factor. So Housing Wire came out with a couple of articles recently, and they're pretty good about the affordability plummeting in the fourth quarter of 2021. So we can see numbers from 2021 versus 2020. So I know this data set, I know we're both kind of data miners, and this data set shows they grab like a certain amount of counties in the United States, and they just track them through ATTOM, ATTOM.
Yep.
That is the company that's kind of mining this data. And they say that in October to December of 2021, the median prices for the 440 of the 575 counties that they analyzed, they saw notable home price growth. And as a result, 77% of those counties included in the report are now labeled as less affordable by ATTOM, ATTOM, up from 39% of the counties from the year before. So they're basically saying that this appreciation of this house is going up so much that you have to be able to afford that house with, a monthly income. So your debt to expenses, I don't know, Mick, what you like to see for debt to income for someone, what their max monthly payment is versus their income.
Yeah.
Well, you have a percentage that you like to use?
We start to bump up against 40%, and then at that point we start to really pay serious attention to it. And the thing is if you're just using that simple data set of information, you could probably filter yourself out of a couple of these deals.
Yep.
I know that they're talking about using more data points to analyze whether a borrower can go ahead and afford that. And lenders can go ahead and start using those pieces of information as a bigger picture to be able to analyze and look at the borrower on a more broad scale. So we're trying. It looks like this type of information is starting to be used to be able to draw more people in and make more loans and more home ownership affordable.
The banks also have a problem too, because they can only lend to a certain set of people now.
That's right.
Right. So there's a credit score criteria that banks generally go off of. Let's say that's not 100% how they go off of, but that's the majority of what they go off of, right?
Right.
And then how much down payment can they put down?
Exactly. And if you've been paying attention for over the last year, I mean, we've covered this many times, you know, it was kind of an unprecedented jump in down payment requirement.
Yeah.
You know, last year, I think it hit like a 20% requirement. And a borrower was, in some instances, in some lenders, they were requiring a 700 plus credit score, even with a 20% down payment.
Yeah.
You know, I mean, is that astronomical or what?
Yeah. It's a big difference.
Yeah.
And then we look at 2006 and you pretty much didn't, they probably gave you money at the closing table and you had to have at least a 500 credit score. And you can get a $500,000 mortgage and make $50,000 a year.
That's it. You know,
it's incredible.
And, well, you remember back then they had what we call liar loans.
Liar loans.
Yeah.
I didn't
stated
know.
Income, stated asset. You could tell them anything you wanted. It didn't
approved, like with a stamp on it.
That's right.
I didn't know that. That's a cool term. I've heard that. Liar loans.
Oh,
I've heard of fogging the mirror. I've heard of stuff like that. But
stated income, stated asset.
Awesome. Totally different time than we are today.
That's true. That's true.
Yeah. So what do we need to do as real estate note investors that's different than the bank so that we know that we're getting a borrower that's going to be able to make these payments and be successful, but they just don't qualify with that bank box, with that credit score, with that down payment? Like what can we do?
Well, that's exactly what, I mean, you're hitting it right on the head. You know, not only are you seeing the affordability of the property, okay, you also have another moving piece, which is the box that the borrower is supposed to fit into.
Yeah.
Okay. The lenders themselves, the big banks, Bank of America, Wells, all these, that box is shrinking. Okay. The easiest way to put that is the box is shrinking and the properties are becoming less affordable. So, I mean, 70% of the people who could qualify for a loan last January can't now. Yeah. And that's an incredible amount of people in the United States. So the best thing to really do in becoming a private lender, okay, if you're going to do owner financing or seller carryback, whatever the term is in your area, you know, you definitely want to do the due diligence on your lender, your borrower. Mm-hmm. Okay. And make sure that you use a qualified registered mortgage loan originator. Mm-hmm. Okay. And this is going to fall right into a very large subject called Dodd-Frank. Mm-hmm. Okay. If you can't sleep at night, go ahead and Google Dodd-Frank and you'll be asleep in no time.
Yeah, okay. No kidding.
Dodd-Frank
like reading the text code.
You got it, man. You know, let's pass a 1,000,000-page, a law and just pass it because it needs to be passed and nobody knows what's in it. But anyways, that was a law that was designed to protect the consumer, but it actually had the backlash of actually freezing other people, borrowers out. So there's a couple of organizations that are out there trying to get that dial back. But the best thing to do is make sure that you are compliant with Dodd-Frank. That's probably one of the most important things you can do.
Let's talk about that for a second for Dodd-Frank. Sure. We won't dive into the specifics of Dodd-Frank. You can look that up on your own offline. But on this topic here, so Dodd-Frank, it put the kibosh. It put some handcuffs on these banks to say, and for right reasons. Let's talk about that. It was for right reasons, okay? Yep. But it went a little too far, a little too stringent. So what it did was a lot of these folks, and Mick, tell me if you disagree, but I think homes under $150,000, this really put a hamper on them to get loans from the bank. Okay, if they had great credit score, they had great down payment, then they are not in this data set. They're outside of this data set. Okay, this is the folks. It's the working class folks in the blue collar areas, blue collar cities that aren't making the large incomes. They have good cash flow coming in. They do deserve to have a home, but they just don't fit in that bank box because they just had unfortunate things happen with their credit history, and they don't have enough data points to support what the normal lending underwriting process is. So those folks fell out of the box pretty quickly. So those were considered high risk loans. So now the banks, they're just not able to make the loans to them. They probably would like to, but they just can't because they don't fit within this regulatory box. Right. So then we got folks like Mick and I that are note investors that we can say, hey, look, I can finance you this property. Obviously, I want to make sure you can afford it. Right. I don't just want to sell it to you. If you can't afford it, but I need to go through other things to figure out, like, I want to see how you're making your payments elsewhere with your phone bill, your credit card. I do care about your credit score, but I want to see where this income is coming in. Do you have multiple people live in your family? Hey, that's great. Let's include that income in this data set as well. Let's see how much you guys can afford. Let's see if this house is going to fit for you. And most of the time, it's going to be like a foreign national comes to mind. It's a great borrower, a person that is definitely doesn't fit the bank box because they probably don't have the proper citizenship credentials, let's just say, to go through the banking process, but they show that they make income and they do live in the country and they do pay taxes. And they typically have a pretty sizable down payment that they can make, and they typically don't have any credit history, but they can show their income that comes in and stuff. And so those are great candidates for seller finance loans, and that's kind of where this bottleneck is. So I believe, Mick, that the rental industry drove way up after the 2008 crash, right around the 12, 13 time frame when we were all buying non-performing loans.
Certainly.
And then that went up because they didn't have anywhere else they could go. These folks, they want to live in a home, but they can't get a bank loan. So what do? So renting was an option, and then renting started to go up because everyone's looking for a rental to have. And so that's why the rent rates went so high. So I think they're still at a level that's pretty high. Mick, would you say?
Absolutely. And I don't really see them coming down too terribly much in the near future. There was an article this morning that Janet and I were discussing actually at the breakfast table from Bloomberg. And they were talking about, the iBuyers like Zillow and what was it, Red Door? Things like that. I think they're big iBuyers, okay? And they messed up. Somebody's algorithm got a little bug in it or something, and they overbought. They bought properties at a much higher price than they really should have. Well, they have created kind of a pipeline to sell these to the large hedge fund investors, okay, which is squeezing out the smaller buyers in any given area. So if you look at the Bloomberg, that's I think it's called the Morning Buzz, Urban Buzz. That's what it was. You can go ahead and read all about that and see that there are factors outside of this that are playing into it as well. So not only are the smaller borrowers, the people who are trying to get into a forever home, are being squeezed out by the banks and lenders, they're also being squeezed out by the market.
There's always somebody that gets left out in any of this legislation that comes through.
That's right.
And I understand that they can't make everything perfect. They can't satisfy all parties, but there needs to be some bend and some give and take. And you had mentioned earlier on this conversation about there's some groups out there that are trying to help that legislation of Dodd-Frank to kind of minimize some of the requirements so that we can help facilitate the needs for private lending, if you will, and seller financing. The regulations are more on our side as the investor or the financier, because we need to go through a process of, if we do a couple of these, we've got to be basically regulated, right, Mick? We got to go through an underwriting process with somebody that's third party outside of our organization, so that there's no bias in that. So if you do have to go through foreclosure, you can show to a judge, like, look, we went through the proper process. Otherwise, you might look at as the P word, predatory lending. Right?
The one important thing to remember with that, okay, is as you have a borrower and they're going through the qualification process. Say you use a company like Call the Underwriter out of Phoenix, Okay. They'll create the file and they will gather all the information on the borrower and they'll present it to you. Okay. Remember, the underwriter does not make the decision on whether to lend or not. You do. As a private lender, you are the one who makes the decision. Okay. That company called the underwriter will make that file, and therefore you are compliant, showing that, yes, we did gather all this information. Yes, the borrower indicated and can prove that he can make the payments comfortably and fall within, a comfort zone. So like you were saying, Justin, exactly. Yeah. If you ever got called to the carpet on it and said, hey, this loan wasn't made properly, you can stand up and say, absolutely, it certainly was. And here's the proof.
Yeah. So that organization is the Seller Finance Coalition that we're talking about. It's a coalition that I believe they started back in 2015 or 2016 to go after Dodd-Frank and get some reform with it, meaning specifically there's some language in there that prevents investors like ourselves being able to do this like before 2008, 2009, 2010.
Right.
In that time frame, you could seller finance, and up to really 2012, you can seller finance as many loans as you want and not have to go through any sort of regulatory underwriting process at all. And you could do an infinite amount of these, and there's nobody putting any sort of ribbon around you to say, okay, no, you got to be within this playground here.
Right.
After 2014, when Dodd-Frank came into effect, things changed a lot, not only for the banks but for small-time investors like ourselves.
Right.
And so they said that we can do a maximum of like 3, I think, with certain criteria. A year is the most you can do without going through that underwriting process. So we, as a community, have just started making this process just be uniform, no matter if it's one or infinity. Gosh, I can't talk. As far as going through the underwriter, just to do things right and compliant. But we're trying to get that reform back down to about 20 to 24.
Right.
And so what that will allow to do is there's a lot of mom and pop sellers out there that have smaller portfolios from 1 to 10 properties that want to be able to seller finance, but they're not at the sophistication level that we are because they haven't had the training and the knowledge and experience in the note world to know kind of how to do it. But we want to be able to help them out as well. And so it helps keep things compliant, because a lot of times we're going to be buying that paper as well. If that paper is not compliant, then you got to fix it before you buy it.
That's right. That's right. Yeah. If anybody's going to start to do this, even if you're only doing one and you say, hey, I don't have to make it compliant. If you've got even the inkling that you're going to do more than 3, start off right. Start it off the right way. Get it, make the first one compliant and make every one of them compliant as you go forward.
It's a small cost of doing business. It's not thousands and thousands of dollars to do this stuff. It's a few $100s. Out of your pocket, going through the underwriting process. And I like what you said, Mick, because a lot of people don't know that, is that the underwriter doesn't make the decision on whether the borrower is going to get the loan or not. You make the decision. They collect the data and they show you and analyze it. Be like, it's within the affordability factor is all they say.
That's it.
If they can afford to pay, they can afford to stay.
That's it. And that's the name of the game. You want a great customer for your bank.
Some of our best loans are not the institutional loans. They are the seller finance loans that we have in our portfolio.
Absolutely true.
We've bought a lot of land contracts. We've converted them to note and mortgages just to help them out, and borrowers like that as well. But our best loans have always been the seller finance loans. Yes.
I will completely agree with you on that one. Yeah. Completely. I don't think I've had our best loans have been just like that, mom and pops who sell to a landlord, or mom and pops who sell to an owner or occupant who just needed a little bit of help. And they're so appreciative that, they'll bend over backwards to make sure that the payment gets made.
Awesome. Mick, that was a good wrap session on this topic here. And so I wanted to ask you some different questions here. Sure. And so is there any, besides reading your book, which is awesome, by the way, and I recommend everybody read it, and it's a quick read and it's well worth it, because you'll revert back to it. It's one of those books to where it's just like, it's like the Robert Kiyosaki book, The Rich Dad, Poor Dad. It's like you always go back and revert to it, because there's something in there that you want to remember. Like, oh, that's what he said. This is that type of book, Mick. I'm being serious.
Thanks,
it's that type of book to where you can go back and you look at it and be like, oh yeah, that's what I'm supposed to do in this situation. I'm telling you, it's totally worth the read. Anyway,
well, thank you.
That's enough plug for you.
You only get a certain amount for a dime, right?
So what type of books do you recommend for note owners or for real estate investors to read that you like to read, or that you, in your experience, investing so far?
Well, Dave Van Horn wrote a book about note investing. His name is Dave Van Horn, and it's a pretty much a basic introduction. Anything that you can find from Eddie Speed. Okay, Eddie Speed has been in this business since the early I think it was 1980.
Yeah,
okay?
like 81, I think. Yeah.
Yeah, he's got like 40 years of experience in this, and
I was just born just a few years before that, Mick.
Oh my! Wow. Well, Eddie has more knowledge in his small finger than I'll ever have in my head. So he's just an incredible knowledge base. If you can find anything from Eddie Speed, Note School, things like that, they are so well worth the read. He's been talking about owner financing and seller financing for years and years and years. And if you can find it, by all means, grab that.
Awesome. Mick, what is the one thing you like to do about real estate the most? Is it the owner financing part of it, the note part of it, or is there another part of real estate you like to do?
That's a great question, right? What I find is the most rewarding and personally rewarding is doing a presentation like a lunch and learn from 12 to 1 in a small office, maybe half a dozen, maybe a dozen people show up, and you do a basic note presentation. Just talking about the opportunity with notes, what you can do with them, how they differ from, sticks and bricks real estate investing. And actually showing how people, busy individuals, busy professionals, just how passive it can be. If you can open your checkbook statement and see that the payment was made, that's all you need to do for that month. So it's just a great. I love showing people what notes do and looking out and seeing somebody's light bulb go off, and they go, "Oh my God, are you kidding me?"
It is. It's funny. You say that, and I think of that exactly the same way. You can just see it go off, and you can see it in their eyes going, "Oh, wow, now I get it." Because at first, you're just like, you're kind of confused. You're kind of stepping into notes, and you don't understand how to make money. Then you're like, "Oh, they get it." Yeah.
Partial. Can you really do that?
Let's not get into that today. We're going to extend this a couple of days if we talk about partials.
That's absolutely.
Mick, thank you so much for being part of my first episode of season 4 on this new branded podcast called Be the Bank. You can check out the video feed of this, and you can see Mick in his little dungeon office there.
That's it.
On our YouTube channel, the BrightPath Notes YouTube channel. And Mick, if there's anybody that wants to get a hold of you, you do your local real estate there in Charleston, South Carolina area.
I do.
Is there a way they can get a hold of you?
Sure. You can reach me either at Mick, that's M-I-C-K, like Mick Jagger. Mick at KTIFinancial.com or Mick at southernbreezesrealestate.com. Either one of them will get right directly to me. If there's anything I can help you with, by all means, reach out. Love to talk, chat with you. And thank you, Justin. It's been an honor. It's been a real pleasure. Thank you.
Welcome, my friend. Don't forget to check out his book on Amazon. It is Property Preservation for Note Owners. I'm holding it up here on the video part of it. You will find that on Amazon, and it is well worth the buy, well worth the read, and you will keep it on your shelf as a go-to piece of information that you will definitely need over and over again. Hopefully you don't need it very often in the worst way, but hopefully it's in a good way.
Yeah, it's like a Band-Aid. It's there if you need it.
All right, Mick, thank you so much again, my friend. This has been episode number 1 of the season number 4 of the Be the Bank podcast. And we look forward to seeing you guys in the next episode.
Yeah. Thanks, Justin.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our BrightPath Notes channel on YouTube and follow us on Facebook and Twitter at Be The Bank and on Instagram at Be The Bank Podcast. Be The Bank is sponsored by BrightPath Notes. Thanks again for listening.